All right, speaking of SPACs, we've got earnings for the king of memes, GameStop, coming out tonight after the bell. We're going to do a little options trading. I got Tom here with me. Joining us, Michael Pachter, is Managing Director of Equity Research at Wedbush. We'll throw another stock in here, too, today in our discussion. But let's start with GameStop. Michael, where are we at in this company? How can they convince investors that they've got a plan?
Well, it would be good if they could just articulate the plan first, and then maybe we could embrace it and endorse it. They've never said what they're going to do. The plan 2 years ago, 3 years ago, was to just be like Amazon, and they hired a bunch of Amazon people and then fired them. There is no plan now. The plan now is that maybe Ryan Cohen is the next Warren Buffett, and he could take their billion plus of cash and turn it into several $billion. But that's a pretty dumb plan. I mean, I think investors do better with mutual funds.
Yeah, look at Chewy. So so much for the Buffett strategy of buying and holding, because Chewy's gotten obliterated. How does it function as a business right now? Like, what's going on there, Michael, when it's been now multiple years with so much opportunity to kind of capture on the zeitgeist, and it doesn't seem like they have? I mean, like, are they just letting this thing die or what?
Well, not intentionally, but yes. The business is dying for the same reason that the typewriter business died, in the buggy whip business died. Technology has allowed for digital downloads of exactly the same content at exactly the same price with a lot more convenience. So the only thing GameStop has to offer customers is the opportunity to trade things in and get value for older games. And obviously you need a physical copy in order to do that. So there are some people hanging on, clinging to the opportunity to trade in. That's great. But the business has gone from, $2 or $3 or $4 billion per quarter to $2 billion. And it's shrinking every year. It's not going to rebound. Digital downloads are increasing. And I think that trend is going to accelerate when the store fees decline online, when Xbox and PlayStation are forced to do what Apple and Google are being forced to do, cut the 30% take down to something closer to 15. Publishers are going to vastly favor digital downloads over physical.
So there's another wave of disruption coming, basically, is what you're saying, from a few of those game distributors?
Yeah, pay attention to Apple, because as goes Apple, so goes the world. Apple lost in the US. They got their butt kicked in the EU. They're being forced to allow competitive stores. So as soon as the game publishers are allowed to do this on Xbox and PlayStation, you're going to buy your Madden football copy directly from EA.com instead of buying it on your Xbox or buying it at GameStop. And if they are allowed to do that, they will make 20% higher margin on that game. It's 20 percentage points. Really a big deal.
Wow, makes sense. Okay, so a deeper level, basically, of direct to consumer, even beyond what we're doing, buying it directly from the console right now. Mike, what about the rise in crypto and speculative madness? I mean, GameStop for a while there was kind of trying to position themselves as like an NFT, a memorabilia collectible. I mean, does any of that give them any solace whatsoever that there's been like $1 trillion market cap rise in that stuff?
There's a huge correlation to memorabilia collectability and game players. So that's right. I think that because memorabilia is physical, obviously pre-NFTs. So sure, that was a smart strategy. It just has never gotten off the ground as a big business. It's it's $1 billion a year. It's under $1 billion a year. But saying that they're correlated to NFTs and crypto is like saying they're correlated to Red Bull and marijuana. I mean, sure, gamers drink Red Bull and smoke marijuana, but do you want to go to GameStop to buy it? No, you're going to go where you normally go to buy it. So NFTs and crypto are better served by Coinbase or Animoca brands. They have a bunch of little companies. The Sandbox is one. You don't need to go to GameStop to buy it, and there's very low correlation to PC users with GameStop. I mean, everybody uses PCs, but GameStop is a console gamers destination. It's not an NFT or crypto speculators destination.
For sure. Okay. Hang with this, Mike, because we're going to talk about a little bit more foundational stock in a moment. But first, Tom, let's trade. Mike's got a single-digit price target on GameStop. Yep. How do you approach this earnings? with that. Well,
volatility expected. Option market's pricing at about plus or minus 23% move in the shares either way. This is one of those diverging stocks amongst a lot of people, right? So you got to be prepared for some decent moves post earnings in this one. So I looked at something that's bearish, where you think it's going to go down, but maybe giving myself some duration. It's not a pure earnings type play.
Okay.
If you're going to use the option market on this and do
got some time on it.
It's out to the May expiration cycle. So 52 days to expiration on this one, where I'm going to sell it out of the money call in May. I'm going to sell that 16 strike call, and then I'm going to buy the 14 strike put. So selling in a neutral,
that's pretty bearish
call vertical or call outright that pays for the put that you're buying on the May 14th strike put.
Is that a Texas hedge?
Yes.
What is that?
We call that a put stupid, because you're doing the same thing on both legs of this spread.
Yeah.
But this is with a high conviction that it's going to go lower over the next nearly 2 months.
Okay.
You're collecting a credit of 75 cents. So what that means is it takes your break even up to 16.75 above the market. Now you got a lot of risk to the upside if this thing does spike to the upside.
Right.
And your profitability is anywhere below that break even price of 16.75. You just keep the 75 cents all the way down to 14, but that's when your profitability, if it continues lower, starts to really ramp up. So combo type trade, bearish risk reversal on this one, where you're buying a put financed by the short call.
And what's the short call strike again?
16.
Oh, wow.
Yeah, so
all
just
right.
about a
bold trade.
Yeah.
Wow. Okay. All
That's
right.
if you're aggressively thinking this thing's going to fall post earnings.
It's a bold trade. I mean, because even if, to Mike's point, there's so many fundamental problems here that I'm totally on board with. But at a time when risk appetite is like roaring again, animal spirits, a little risky if I had
and short open interest. But that's why I didn't make this example in earnings type play short term.
Right.
It's got a little bit more duration on it.
But you're going to be testing your stomach if it rips past 16. Better have a strong stomach.
17, I'd say.
Okay. All right. Hey, Michael, while we got you, let's talk some Netflix here, a real stock with real plans and real recovery. Your coverage of it has been pretty great over the last couple of years, warning about some of the problems before the market figured it out, then been back bullish and quite bullish here at this juncture for Netflix. Is that right?
Yes. Yeah,
Tell me about it.
They're doing everything right. I'm sorry, open question. Look, they have a couple of initiatives that are just working flawlessly. One is the password crackdown, and the way they executed was just brilliant. They aren't saying to people, you have to pay for a full subscription. They're saying the sponsor who allowed his kids to use the password can pay an incremental half price, $6.99 for additional accounts. My kids are 24, college grads. I'm paying the $6.99 for them because it just doesn't make sense to allow them to pay $15.49. The second thing they did was they added advertising, and we're still waiting to see that generate material contribution. But the ad rates that they're getting are pretty high, $40 per 1,000 views, which is pretty decent. It looks like the few accounts that have switched over are generating actually more revenue than the full priced account. And you're going to see that increase as more below median income households sign up. And where I think that's especially powerful is internationally. I think that these guys have another probably 40, 50 million subscribers to grow. And I think you're going to continually see ARPU, average revenue, go up on each household. And they're profitable. They've actually gotten smart about pulling back on content spend. So they're at the steady state. They produce enough content to keep people happy, and incremental revenue is just going to drop to the bottom line. So they're very profitable. They're looking like a slow growth, highly profitable company. That's a good combination.
Absolutely. All right. Thanks, Mike, for your time. Always appreciate the analysis. Good stuff. Great analysis here. All right, so Mike's price target a little bit below where we're at right now, but he's still got the buy, the outperform rating on it. So liking it, and pretty strong words there.
Yeah, I think if you take a look at the trajectory, all-time high is about $700. That was about 2.5 years ago. So we haven't hit that level yet, but they've got earnings on the 18th of April, so we'll get some more clarity on their growth numbers and stuff. So I looked at a strategy that avoids that. But takes advantage of, maybe the move that we've already had, maybe some consolidations warranted right here with the stock up 27% so far this year. So I looked at a short iron condor but I skewed it a little bit to the upside where I don't have as much risk. So going out to the April 12th weekly cycle, so 17 days to expiration, you'll avoid that earnings that comes on the 18th with this type of strategy, which is what you want, right? You don't want that event risk in this type of neutral strategy. So sell the 605 strike put, buy the 595 strike put. So a short, $10 wide neutral to bullish put vertical, right? And then on the call side, out of the money calls, it will sell the 660 call, buy the 665 call. So only a short $5 wide neutral to bearish call vertical. So both of these verticals are out of the money. The put side's $10 wide, call side's $5 wide. You're collecting roughly a credit of about $3.20. That's what you can make on this strategy. And if you look at the risk profile here, you've got a nice wide range for this stock to trade in before you start getting hurt on it. And that's all the way down at 601.80 on the downside and 663.20 on the upside. Now, I've got a little bit more room on the upside on this one in case it does continue to grind higher here, but you've got more risk on the downside. So if you collect 320, you've got about $680 in risk, and that's below 595. And then on the upside, you've only got 200 or about 180 bucks in risk, and that's above 665. So I skewed it a little bit where you've got more risk to the downside, and you've got more room to the upside because that probability of that short 660 call being out of the money at expiration is about 83%. And about 68% on the short 605 put. That's what you want, higher probabilities of success, but this is definitely neutral strategy that takes advantage of some consolidation, but gives you a little bit more room to the upside if you think it's going to grind higher too.
Okay, all right, so way to capture Netflix's steady ascent and maybe back to records as we still are below those.
Yeah.
All right, thanks, Tom, for the trades. Michael Pachter for the analysis.